The S&P 500 just hit an all-time high. The headline says the market is booming. But here's the strange part. On that same record day, more stocks inside the index can be falling than rising. So how does the market set a record while most of it is heading the other way? The answer is a number almost nobody outside a trading desk talks about. And it's one of the best tells for whether a rally is actually healthy. It's called market breadth. Start with how a stock index works, because that's where the illusion comes from. The S&P 500 is cap-weighted. The biggest companies count for the most. A small handful of giant stocks can carry the entire index higher, even while the other 400 and something are flat or falling. The index goes up. The average stock doesn't. Market breadth is simply the measure of how many stocks are actually taking part in a move, whether a rally is the whole team pushing or just a few stars carrying everyone else. So how do you see participation? The most direct gauge is the advanced decline line, a running tally of how many stocks rose versus fell each day, added up over time. When the index is climbing and the advanced decline line is climbing with it, that's a broad, healthy rally. Most stocks are along for the ride. When the index keeps making new highs, but the advanced decline line flattens or rolls over, that's the warning. Fewer and fewer names are doing the lifting. There are other windows into the same question. You can look at the share of stocks trading above their 200-day moving average. A quick read on how many are in their own uptrend, not just riding the index. You can watch new highs against new lows. Or you can compare the regular S&P to an equal weight version of the same 500 stocks, where a corner store-sized company counts the same as a trillion-dollar tech giant. When the cap-weighted index is racing ahead of the equal weight one, that's your tell that a few mega caps are doing the work. Here's why any of this is worth your attention. Breadth is really a measure of how fragile a rally is. When leadership narrows to a few names, the whole index is hostage to those names. If they stumble, there's nothing underneath to catch it. A broad rally where most stocks are rising together has a deeper base, and it tends to be more durable. That's why the classic warning before some of history's biggest market tops wasn't the index turning down. The index was still making new highs. It was breadth quietly deteriorating underneath, months before the headline number finally cracked. The dot-com peak is the textbook case, a shrinking group of giants holding the index up while the broad market had already begun to sag. But, and this matters, narrow breadth is a risk gauge, not a sell signal. This is where a lot of people misuse it. Narrow rallies can run for a long time before anything breaks. The market's too top-heavy has been an early call far more often than a timely one. Breadth tells you how much cushion a rally has, not when it ends. It raises a yellow flag, not a red one. Treat it as a read on the quality of a move, not a countdown timer. So come back to that record high. A new all-time high isn't a verdict on the whole market. It's a verdict on whatever's carrying the index that day. Breadth is what tells you the difference between a rally with 500 stocks behind it and a rally with 5. So next time you see the market hit a record, the sharper question isn't, is the market up? It's, how much of the market is actually up? Because that's the part the headline number will never tell you. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.